Got no problem if people want to buy Bitcoin. I mean, I think it's a foolish thing to do. I think it's a digital pyramid scheme.
In this video, we explore Peter Schiff's strong criticisms of Bitcoin, contrasting it with gold's enduring value. Schiff argues that Bitcoin is a digital pyramid scheme destined for collapse, driven by speculation rather than utility. Before we dive in, if you've ever considered investing, the first link in the description will lead you to Interactive Brokers, the platform I personally use and highly recommend for its robust features and competitive pricing. Introduction to Bitcoin critique. Bitcoin has become a polarizing topic. Many view it as the future of finance, while others see it as a fleeting trend. Critics like Peter Schiff argue that Bitcoin lacks intrinsic value. They believe it serves more as a speculative asset than a legitimate currency. This critique is rooted in a deeper understanding of economic principles and historical trends. Schiff's perspective highlights the potential pitfalls of investing in Bitcoin. He warns that many investors may face significant losses. The allure of quick profits can cloud judgment. Understanding the underlying risks is crucial for anyone considering an investment in Bitcoin. The growth of the Bitcoin bubble. Bitcoin's price surge has drawn both excitement and concern. Many attribute this growth to a mix of speculation and institutional interest. The introduction of Bitcoin ETFs has played a significant role. Wall Street's entry into the market has pushed prices higher, attracting a wave of retail investors. However, this rise is not necessarily indicative of a sustainable trend. The rapid increase in value can be likened to a bubble. Bubbles are characterized by inflated prices driven by speculation rather than genuine demand. As more people buy in hopes of future gains, the risk of a sharp decline becomes more pronounced. Assessing Bitcoin's value. Determining Bitcoin's true value is complex. Unlike traditional assets, Bitcoin lacks intrinsic value. It does not generate cash flow or dividends. Many argue that it serves primarily as a store of value akin to digital gold. However, this comparison raises questions about its practical utility. Critics point out that Bitcoin's volatility undermines its role as a stable store of value. Price fluctuations can be extreme, making it unreliable for everyday transactions. Furthermore, the lack of widespread acceptance as a currency limits its practical application. The selling trend among investors. As Bitcoin's price rises, so does the temptation to sell. Many early adopters have realized substantial profits. This trend can create a domino effect. As more investors sell, it can lead to a rapid decline in price, unsettling those still holding Bitcoin. The fear of missing out drives many to buy at high prices. Yet, this same fear can trigger panic selling when prices start to drop. This behavior reflects the speculative nature of the market. It highlights the risks involved in chasing trends without a solid understanding of the underlying asset. Political implications of Bitcoin reserves. The idea of a national Bitcoin reserve introduces a new layer of complexity. Proposals for governments to hold Bitcoin are controversial. Critics argue that this could lead to irresponsible financial practices. Using taxpayer money to invest in a volatile asset raises ethical concerns. Moreover, such a move could set a dangerous precedent. It blurs the lines between public funds and speculative investments. The implications for economic stability could be far-reaching. It raises questions about the government's role in private investment decisions. The diminishing buyer base. As the initial excitement wanes, the pool of new buyers may be shrinking. Many potential investors are becoming wary of the risks. The narrative that Bitcoin is a guaranteed path to wealth is losing its appeal. This shift in sentiment could impact Bitcoin's price stability. Without a steady influx of new buyers, the market could struggle to maintain its inflated valuations. This reality may lead to increased volatility. As the market matures, the speculative frenzy may give way to a more cautious approach. Understanding the dynamics of supply and demand will be crucial for future investors. Comparing Bitcoin to gold. Bitcoin is often compared to gold. Both are seen as stores of value. However, the similarities end there. Gold has intrinsic value and utility. It has been used for thousands of years in various applications. Bitcoin, on the other hand, is a relatively new digital asset. Its value is based largely on speculation and belief. Gold is a physical commodity. It can be used in jewelry, electronics, and as an investment. This versatility gives it a stable demand. Bitcoin lacks this physical presence. Its existence is entirely digital, which raises questions about its long-term viability. Supporters argue that Bitcoin's limited supply mimics gold's scarcity. However, the reality is different. There are thousands of cryptocurrencies with similar supply caps. The uniqueness that gold possesses cannot be replicated by Bitcoin. This fundamental difference impacts how each is perceived in the market. For those interested in learning more about investing, I've had a positive experience with Interactive Brokers. The link to their platform is in the first link of the video description. The role of ETFs in Bitcoin's rise. Exchange-traded funds, or ETFs, have significantly influenced Bitcoin's trajectory. They have opened the door for institutional investors. This influx of capital has driven Bitcoin's price to new heights. However, the motivations behind these investments often focus on speculation. Investors are not buying Bitcoin through ETFs to use it as a currency. They are betting on its appreciation. This speculative nature can create unsustainable price increases. When the market sentiment shifts, these prices can plummet just as quickly. ETFs have provided a convenient way for investors to gain exposure to Bitcoin. However, they have also contributed to the bubble mentality surrounding the asset. As more institutional money flows in, the risk of a sharp correction grows. The market dynamics shift from genuine demand to mere speculation. The misconception of limited supply. Many Bitcoin proponents tout its limited supply as a key advantage. They argue that only 21 million Bitcoin will ever exist. This scarcity is compared to gold's finite quantity. However, this argument overlooks a critical point. Just because the supply of Bitcoin is limited does not mean it has inherent value. In reality, the cryptocurrency market is flooded with alternatives. New coins can be created with their own supply limits. This undermines the argument that Bitcoin's scarcity is unique. The value of an asset comes from its utility and demand, not just its supply. Gold's value is supported by its various applications. It is used in industries ranging from electronics to medicine. Bitcoin, however, struggles to find practical uses beyond speculation. This lack of utility raises questions about its long-term sustainability in financial markets. The impact of Bitcoin on the economy. Bitcoin's rise has broader implications for the economy. The resources allocated to mining and trading Bitcoin could be used more productively. Investing in Bitcoin can divert funds from essential sectors. This misallocation can hinder economic growth and innovation. Moreover, the speculative nature of Bitcoin can contribute to economic instability. When investors chase quick profits, they increase volatility. This can lead to sharp price corrections. Such fluctuations can have ripple effects throughout the economy. In a world where productive investment is crucial, Bitcoin represents a distraction. The focus on speculative gains can overshadow genuine economic development. This misdirection of capital can ultimately harm society. The consequences of government involvement. The prospect of government involvement in Bitcoin raises serious concerns. Proposals for national Bitcoin reserves could set a dangerous precedent. Using taxpayer money to invest in a volatile asset is irresponsible. It blurs the lines between public funds and speculative investments. Government actions can distort market dynamics. When a state buys into Bitcoin, it may create artificial demand. This can inflate prices, leading to unsustainable market conditions. If the market corrects, taxpayers could be left holding the bag. Furthermore, such involvement undermines the fundamental principles of Bitcoin. It was designed as a decentralized alternative to government-controlled currencies. By introducing state influence, the original vision of Bitcoin is compromised. This contradiction can erode trust in the asset. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link